Are you tired of quick fix promises and get-rich-quick schemes? Today, we're diving deep into the real truth about getting rich slowly. I'll show you why slow and steady wins the race, and how building wealth over time is not only possible, but also more sustainable. Starting early is crucial when it comes to building wealth through investing. Imagine you start saving just $100 a month at age 25. If that money grows at an average annual rate of 7%, by the time you're 65, you'll have amassed over $430,000. That's the power of compound interest in action. But what if you wait until you're 35 to start saving? By then, you need to save about $200 a month to reach the same amount by age 65. If you delay even further and start at 45, you'd have to set aside nearly $600 a month to end up with that same retirement nest egg. The earlier you begin, the less money you need to put away each month to achieve your financial goals. It's not just about saving more. It's about giving yourself time for those savings to grow exponentially over decades. Starting early might mean making small sacrifices now, like skipping a fancy coffee every day, but these minor adjustments can lead to significant wealth in the long run. So, don't underestimate the impact of starting your financial journey young. Every dollar and every month you save early is an investment in your future self. Saving consistently is the backbone of building wealth over time. It's not about saving big chunks all at once, but making small deposits regularly that add up to something huge. Imagine starting with just $50 a month when you're young and earning 7% annual returns. Over 40 years, those monthly savings would grow to nearly $230,000. That's the power of starting early and sticking to it. The key is to automate your savings so it becomes effortless. Set up automatic transfers from your checking account to a retirement or investment account right after you get paid. This way, saving isn't an option but a default. It might seem insignificant at first, but those small amounts accumulate rapidly over time, thanks to compound interest. Consistency also means not skipping months when things get tight. Even in tough times, find a way to put something aside, no matter how little it is. This discipline will pay off immensely as you watch your savings grow year after year. Saving consistently turns every dollar into a long-term ally in your quest for financial independence. Investing wisely is a cornerstone of building wealth over time. The key here isn't just putting your money in any investment, but choosing ones that align with your financial goals and risk tolerance. For example, if you're looking to retire comfortably at 65, it's wise to invest primarily in stocks and bonds early on because they historically offer higher returns compared to conservative options like cash or short-term CDs. When picking investments, consider mutual funds or ETFs, exchange-traded funds, rather than individual stocks. These funds spread your money across many companies, which reduces risk through diversification. Let's say you have $5,000 to invest in a mutual fund that holds 100 different technology companies. If one company performs poorly, the others can compensate for it. Another critical aspect of wise investing is understanding fees. High management fees and transaction costs can eat into your returns over time. Look for low-cost index funds or ETFs with expense ratios below 0.2%, which can significantly increase your net gains in the long run. Lastly, resist the temptation to chase hot tips or trendy investments. Stick to a balanced portfolio that suits your risk profile and rebalance it periodically to ensure you're not straying too far from your goals. This disciplined approach helps you stay on track toward financial success without getting sidetracked by market noise or hype. Diversification is a cornerstone of wealth building because it reduces risk by spreading your investments across different types of assets. Think of it like not putting all your eggs in one basket. For instance, imagine you have $10,000 to invest. Instead of pouring everything into stocks, consider splitting that amount among various asset classes like bonds, real estate, and even cryptocurrencies. Stocks might offer higher returns but come with greater volatility, whereas bonds tend to be more stable but yield lower growth over time. Real estate can provide steady income through rental properties, while crypto offers exposure to cutting-edge technology. By spreading your investments across these diverse categories, you protect yourself from market downturns in any single area. The key is to find the right balance for your risk tolerance and financial goals. Younger investors might lean towards more stocks since they have time on their side to recover from potential losses. As you age, you may want to shift towards safer assets like bonds or real estate. Remember, diversification isn't about making huge profits overnight. It's about safeguarding what you've worked hard to accumulate and growing your wealth steadily over the long term. Staying disciplined is easier said than done. It's like trying to stick to a diet when you're surrounded by tasty treats every day. Imagine setting aside 20% of your income each month for investments. That might seem tough at first, but it gets easier with time. You start noticing how much better off you are in the long run. The key is consistency. Missing just one payment can set back your progress. It's like missing a single workout in a week. It won't ruin your fitness goals, but skipping them regularly will definitely slow you down. So, automate your savings and investments if you need to. Set up direct deposits into your investment accounts right after your paycheck comes in. This way, you never have to think about it. You're saving before you even realize what's happening. And when the market dips and everyone else is panicking, resist the urge to bail out. That's the time to stay disciplined and maybe even buy more if you can afford it. Remember, long-term success isn't about making big splashes. It's about consistently staying on course through all seasons of the economy. When you start saving early and consistently, compound interest is your best friend. Imagine you're 25 years old and decide to invest $100 a month in a stock market index fund that averages an 8% annual return. By age 65, those regular contributions grow to over $400,000. But here's the magic of compound interest. If you wait just 5 years to start, your final amount drops by nearly half, down to around $230,000. Compound interest works because it earns interest on both your initial investment and the accumulated interest from previous periods. This exponential growth is why the early bird gets the worm in investing. Let's break it down. At age 25, you invest for 40 years. At age 30, just 35 years. That 5-year difference costs you about $170,000. To maximize compound interest power, start as early as possible and keep contributing consistently. Even small monthly investments grow significantly over time, thanks to the magic of compounding. Remember, every dollar you save today is worth more tomorrow because it earns interest on its own growth. So, don't wait, start investing now to see your money multiply in the long run. As your financial journey progresses, you'll need to adjust your strategies based on changes in your life and the economy. For instance, if you start a family or change jobs, reassessing your risk tolerance is crucial. Early in your career, you might be more comfortable with higher risk investments like stocks for long-term growth. However, as retirement approaches, shifting towards safer options like bonds can help protect your hard-earned savings. It's also important to stay informed about market trends and economic shifts that could affect your portfolio. For example, if interest rates are rising, you might want to consider selling some bond funds and buying stocks or real estate, which tend to perform better in a high interest rate environment. Regular reviews of your investment mix can help ensure it aligns with your goals and risk tolerance. Many financial advisors recommend rebalancing your portfolio once a year, but this can vary based on personal circumstances. For instance, if one asset class has grown significantly relative to others, bringing it back in line might be necessary to maintain your desired allocation. Remember, the key is flexibility. Being adaptable allows you to take advantage of opportunities while minimizing risks. By staying vigilant and adjusting as needed, you'll continue building wealth effectively over time. In today's video, we've explored the truth behind getting rich slowly and why it's a smarter path to financial success. Remember, patience and persistence are key. Subscribe to Cash Decoded for more practical finance tips and insights.